My name is Baron, that's Barron, and for this video we're going to be talking about the types of securities, basically about common stocks, bonds, and options. This is going to be just a general overview of all three of those. Common stock, what is it? So common stock represents a part of a company. These investments are moderately risky and are valued based on speculative and intrinsic values. An example of a speculative value would be something like the psychological mindset of the investors, and an intrinsic value could be the assets that are held by the company or the debt that they have. It is important to note that the stock is not consistently valued in line with the intrinsic value of the company, and many probably have heard it. It's Warren Buffett's investing technique. The manipulation of these characteristics is called value investing, and I plan to do a video on that in the future. Basically, why this is important to note is that many companies can be overvalued from their actual assets on hand, or their net worth of the company, and they can also be undervalued, which would be basically a discounted price from its book value. And this means that a common stock investor must be wary of speculative as well as the intrinsic characteristics. So when you're looking at a stock, you should be very cautious of not only what's going on psychologically in the minds of investors and how much volume is coming into the stock, etc., but you should also be taking into account the actual value of the company, what it's worth, how much it's bringing in, how consistent it is, etc. Most stocks are represented by a 1 to 5 letter symbol called a ticker symbol. An example of this could be Goog, which is Alphabet, or the parent company of Google, or TSLA, which is Tesla, the electric vehicle manufacturer. So here we got an example of the common stock. For this example, I chose Apple, which ticker symbol is APPL. And the reason I chose this is because it's very commonly known. Many of you are probably watching this on an Apple device. And APPL currently has an outstanding shares of 15,787,154,000 shares, and each share individually is priced at $191.81 at the time of this video. So essentially what this means is each individual share you purchase of the company would cost you $191.81. In order to find out the total value of the company, we have to multiply the shares outstanding by the price of each individual shares. So this means that the company will be valued at $3 trillion. You can use the total outstanding shares to find out how much of the company you own. Say you own 10 million shares of Apple, then you would own 0.063% of Apple. And you can find this out by dividing the total shares you own to the total outstanding shares. In order to make money on a trade of Apple, you would need to buy it at its current price and sell it at a higher value. What many people fail to understand is that there must be a literal exchange of stock when you sell or buy it. This means that someone must buy the stock of someone who's selling the stock, and or someone who is selling the stock must sell to someone who is buying the stock. And this is very important to know, because if there's not a large selling pressure, then you may not be able to buy. And if there's not a large buying pressure, then you may not be able to sell. It's all up to variation. Since we're talking about purchasing and selling the stock, the purchase and sale of a stock is called the volume. The volume is measured in specific periods. The average volume of APPL in a trading day is 58,105,831 shares. This means that all these shares were either sold or bought within the trading day. Alright, now we're on to bonds. A bond is essentially a loan from the investor to the company and is required to be paid back by a certain date. They are considered to be the safest securities available, and you will see why soon. Not all public companies offer bonds. This is important to note, because if you have a lot of faith in a company and you find interest in it, but you are interested in buying bonds only, it may not be available for you to buy a bond from said company. A bond investor makes their money through interest that debt makes. So when the company loans out money, or when you loan out money to a company, they are required to pay interest on that to you in the form of a yield. The principal is of a bond is the money that a company must pay the investor by the expiration date of a bond. Now, this will always be greater than the money you paid for the bond, but it will not vary. They will always pay the same amount that they said that they would pay you on the date the bond released. And the coupon rate of a bond represents the interest made from a bond in percent form. This will be the yield that you make on average if the bond isn't selling at a discount at a premium price. The maturity date, also referred to as the expiration date, is the day the principal must be paid to the investor. There's no kind of differentiation on this date. It will always be standard and set. These reasons are why bonds are some of the safest investments you can make. It's because they have a consistent yield over their lifetime, and they will always pay out on a specific date. So you know you will get your money no matter if the company is struggling or not. In the case of a bankruptcy, bondholders will always be paid first. This means that the common stockholders, they will suffer and will not see their money returned to them as fast as the bondholders will. Alright, bonds, what are they? Continued. Bonds can either sell at premiums or discounts. This is very important to note if you want to get a higher yield than from the face value of the bond. If a bond has a face value of $100 and has a yield of 5% to its principal value a year, then the investor will make $5 a year. However, if the bond is sold to another investor at a premium of $110, the bond will reap $5 a year still, but now the yield is only 4.5%. This makes sense because if you have more money, but you're still getting the same return, you're making less percentage per year. At a discounted value of $90, the bond will produce $5 annually still, but it will have a yield of 5.5% on your money, respectively. In order to find out when a bond is selling at a premium or a discount, you can always take a look at the interest rates, because the value of a bond is in coordination with the interest rates. If a bond's interest rate is lower than the coupon rate of the bond, then it'll sell at a premium. But if the interest rate is higher than the coupon rate of the bond, then it'll sell at a discount. There are two types of bonds. Well, there are many more, but two main types of bonds. We have junk bonds and we have investment grade bonds. Junk bonds have higher risk but higher yield traditionally, but they're also investment grade bonds, which give low interest rates but are generally safer. Options are by far the most speculative and advanced security. It is very complicated to properly trade options, but after you learn how to do them, the rewards can be exponential. Options are essentially the right to buy security at a given price at a certain time in the future. The investor is required to pay a premium for the right to buy a security at a given price. This means they are expected to pay an extra amount to the seller of the option in order to have the right to buy it at a later date at a specified price. It is important to note that the investor is not required to make this purchase after buying the right to purchase it at a later date and at a specific price. But they are allowed to if they so please. And if the value of the security at the time of the option's expiration is not favorable to the investor, then they will likely allow the option to expire and take the loss of the premium. If the price of the security is favorable and the options trader would like to make the purchase at a discounted value to the current market price, then they will take a profit. Options are divided into two categories. There's a call contract and a put contract. The purchaser of a call contract has purchased the right to buy a security in the future at a pre-specified price. This is what's known as a strike price. The put contract, the purchaser of this contract has purchased the right to sell a security at a future predetermined price. This was first introduced in order to cushion the losses that investors would experience on big market drops. Options contracts almost exclusively come in volumes of 100 shares. This makes it an expensive investment niche for the beginner. Alright, comment what you would like to learn about next, and like this video if you want me to explain other securities. I apologize if I got a few things wrong. I'm not that up to date on options trading, but let me know down below.